Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an.
Welcome to the Stock Play of the Day. Today's stock is the CBOE. That's the Chicago Board Option Exchange. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist at Ally Invest.
Well, Lindsey, we have a chart of the S&P 500 index. We had probably the biggest week of earnings last week. What do we see going forward this week in the SPX?
Yeah, I mean, it's going to be another busy week of earnings, but not quite as busy as last week. The first trading day of August, Brian, and July closed what was a 4-month earnings. In July, the index advanced 5.5%. It has been on a pretty solid tear since that March 23rd low. We'll see if that can continue in the month of August. August is usually a pretty muted month for the index as you get into the end of summer. But we know this summer has not been like any other summer we've had before, but today we're kicking off the month of August on a positive note. And I think part of that has been related to some economic data that we got out. China's manufacturing PMI data came in better than expected, showing that the recovery over there is underway. I think this was the second month in a row for the reading to be above 50, and that anything above 50 for that reading means that part of their economy, manufacturing, is in an expansion. We also got similar data from the U.S. and Europe. Europe manufacturing data was about in line, which was a positive. And then in the U.S., we got some pretty strong numbers. The ISM coming in better than what the consensus had expected. We saw that production and order creeped much higher, which was good. The ISM was expanded at the fastest rate since March of 2019. Sorry, just checking my notes to make sure I had the date memorized. So that's all very good stuff. I think there's hopes that we're going to get a stimulus package passed here in Congress in the next week or so before they go on their August 10th their recess. So there's that. And then we got tech again leading today, Brian. It's been the summer, Apple, Microsoft leading the way today, all despite the uncertainty around coronavirus and the trajectory of what's going to happen there. We did get some more good news on the vaccine front. There is one of the vaccines, I think it's Pfizer, if I can remember correctly, is entering the stage 3 trials today. So that's good. But there's some different indicators. The 10-year yield is kind of creeping a little bit lower over the last couple days. You've got the VIX that's, in that 25 range, creeping a little higher today. Gold doing well, which we talked about, I think it was last week. But let's talk about that VIX, Brian, because it ties in really nicely with what our stock play of the day is, the CBOE. So the VIX is, I think, just under 25 right now. What do you make of that move?
Right. Well, one of the biggest things about the VIX and the Chicago Board Option Exchange is that it is a proprietary product of the CBOE. And it's odd that the VIX stays so high in an up market. We got the VIX trading around 25%, actually a little north of 25% at this point in time. And when that happens, that usually means that there's a lot of nervousness in the marketplace, that the people don't necessarily believe the move that we've had to the upside since the March lows. As far as the Chicago Board Option Exchange is concerned, by it being a proprietary product, they actually receive income from that product. And they actually do a little bit better when the VIX is moving. That means that people are going to be more apt to trade it. It is a volatility index. And as a matter of fact, it's kind of odd to mention this. A lot of people might not know out there in YouTube land, but the VIX actually has a volatility index that tracks the VIX. It's called the VVIX, and that shows the volatility of the options inside the volatility index. And recently, the VVIX has actually came off a little bit because there's just not a lot of movement actually in the VIX index. It stubbornly hangs around that 25% level, which means overall, usually the VIX will have a tendency to go back towards a mean, like maybe a 2-year or a 3-year mean. But recently, since this March low, since this pandemic has hit, the new norm is right around that 25% level, and it's just hanging there. It still means that there's a lot of nervousness in the marketplace and that people are willing to pay up for options. They're willing to pay up for calls and puts equally on both sides. And there's a little bit more nervousness in the marketplace because we keep hanging at that level. But the VIX not moving actually kind of affects the stock that we're looking at today. Now, before I pass it back to you to talk a little bit about today's stock, I wanted to also highlight on the SPX chart, which I have up here right now and I'm showing you, that we've seen some movement recently, and this kind of is a reason why the Chicago Board or the VIX index is not moving very much, is that we've had a lot of consolidation in the SPX. And if we were to look at the small caps, the Russell or the IWM, if you want to look at the ETF, that stock the Russell is not really leading us higher, and it's added some nervousness in that. We'd really like to get this economy flowing, and small caps really need to start breaking out a little bit before we can really start moving to the upside and maybe bring that VIX back down to that 15 handle level. But this is a very interesting level, and I have it highlighted here in the blue segments that I have drawn on the chart. We had a little bit of a breakout today, but there's this little gap that's going on in the SPX that started to on the drop down in March in the S&P 500 index, and it would be very interesting if we could fill this gap and start to track towards a new high in the S&P 500 index. Now, we kind of broke out a little bit to the upside out of this little just doldrums that we've seen the last 4 or 5 sessions in the S&P 500 index. So overall, I think that is a good thing. But the VIX, still remains flat. Even though we drive a little bit higher, the nervousness of the marketplace just won't go away. And that's why the VIX is trading where it's at. Chicago Board Option Exchange would be a little bit better if we actually added some volatility. And it's kind of hard to say because it's very volatile at times. But one of the things that has happened with the VIX product is the fact that it's not moving. Volumes have dried up a little bit. And that was pretty relevant in their earnings report that they just announced last week. So let's get back to the CBOE. That's the symbol. And let's talk a little bit about what that earnings report said, Lindsey.
Yeah, definitely, Brian. Before I do that, I know you're going to switch charts here. But just a reminder to the viewers that there is a chat box on the right-hand side of the YouTube live stream here. And Brian and I will take your questions at the end, live, real time. So be sure to type them out there, and we'll get to as many as we can at the end of the show. But now Brian's pulled up the CBOE chart here. It doesn't look exactly like the S&P 500. It's come off of its early June most recent peaks. It's only up about 14% off of its March lows. And it still remains quite a ways away from the pre-COVID peak that we saw. Now, like Brian talked about a bunch of the fundamental reasons why the stock has been trending downwards more recently. And a lot of that has to do with what they call their proprietary products in the VIX. And Brian did a great job of explaining how they make money off of that. The fact that that product has been stuck around that 25 range for quite a while means there hasn't been as much volume around it. So there's less trading going on because it's not moving. And so the CBO really needs that type of product to move around for them to increase volumes and then make money. And that just didn't really happen in the last quarter. And they make the most money off of these proprietary type products, right? It's really the only place you can go and trade these types of products. And that's what makes the CBOE so unique. But there was good news in the quarter, and that really came from their equity related products and their equity options trading platform. And they really got to see significant volume there, which really shouldn't have been too much of a surprise. I was expecting that after listening to a lot of the bank earnings and some of the broker dealer earnings, where they talked about significantly increased or elevated levels of volumes and trading over the course of the quarter, which had really begun when the crisis started in March. Those elevated levels have remained intact for a lot of the banks and other players in the space. So the CBOE benefited from that, a lot more trading happening, of course, and a lot more options trading as well was a benefit, and that helped offset the lower revenue from the proprietary product side of the business, which was a good thing. But really, investors want to see that proprietary side of the business pick back up because, like I said, they make a lot more money. The margins on those products are a lot better, whereas times investors can view the equity trading and option trading portion of this as a commoditized at other places. So that's kind of how investors are viewing the stock. It might be why we've seen a drift lower in the stock more recently. But overall, this does remain a pretty diversified play. Brian, you probably remembered when they bought BATS back in 2017 to help diversify into new product lines, which was a really good thing. But I think for the market to get more excited about this stock, you're going to need volumes in the VIX and other products to start picking back up. And that's going to only really happen if we get some major movement in the VIX. The VIX has come down, Brian. Like you said, it was back when the market was plummeting in March, and obviously the stock, as well as almost every other stock, pretty much plummeted back then. The VIX spiked up to above 80, which was a huge number. Now we're hovering around 25, which is just above average. The historical average VIX has been 19, so anything I'm getting a little nervous. And there's just honestly still a decent amount of uncertainty out there about COVID and what that means for the economic recovery going forward. We've seen a spike of cases. Is it getting under control? Will the vaccine be available by year end or early next year? There's a lot of questions out there of how really get out of this. And I think that on the conference call, the CBOE conference call, the management team really put it best. They were able to beat on the bottom line. They beat earnings last week, but sales were kind of weak because of those lower volumes. And it's just really, it's the institutional traders. They're the ones that are trading big the VIX and the other proprietary products, right? Well, they call them convictionless, given the current environment we're operating in. And so we need more conviction among those institutional players with the big money that can make the big bets on those types of products to really get the stock going. But you never know. Holds from a fundamental perspective. It was nice to see them report last week. We've got that big event out of the way. So now we're looking forward. And Brian, you were looking at the options change this morning. You kind of went back and forth on a couple different trades. The stock is trading down a little bit today, but it seems a little bit choppy in a really nice up market. So what kind of options play would you consider today, looking at the stock and knowing what we heard from the earnings report last week?
All right. So yes, and if we look at the CBOE chart, we do see that the stock is down a little bit today. So today's stock, or I should say options trade, which is not meant to be a recommendation, so we always call it the paper trade here on the stock play of the day. One of the things that we're looking for is value. We're saying that overall the fundamentals of the Chicago Board Option Exchange are fairly solid, but we've seen a little bit of a downturn in some of their proprietary products. Hopefully, if we get a little bit more volatility back, that can bring back some of those volumes. They also trade the S&P 500 index, which is the SPX. That's another one of their products that they trade. So overall, if we're looking at the CBOE, we're going to just look at a trade where we're looking for some value. We got a little bit of a down day. So if there's a stock that you wouldn't mind buying if it went a little bit lower, the strategy that we'd like to talk about is a cash secured put. It's a very simple, straightforward strategy, but when you sell a put option, you're saying that if the stock gets to this strike, which is usually below where the underlying stock is at, you're willing to buy 100 shares of it. So here is inside the Ally Invest Options playbook, we have the cash secured put strategy. And you'll see here that if we sell a put and we're doing it cash secured, saying that we do want to buy the stock, we have the monies to be able to buy the stock if we are put the stock. Once we buy it, our cost basis is basically wherever we would be put the stock minus the premium received. And then we've kind of tried to display this inside the options playbook by doing a dotted line. That basically means that if you get put the stock, then basically you're a stock owner and you have all the upside of owning stock and all the downside of owning stock. If I just sell the put and the market goes on up, well, I can make the premium from selling that put option. So if the stock goes the opposite direction, doesn't come down anymore, continues on up, well, then I can still profit on this trade by that option expiring worthless, and I get to receive that premium, that cash. So this is just a play saying that if this stock does go a little bit lower and we see a little bit more value in it, why not buy 100 shares at that lower price? So how do we do that? Well, let's go into the Ally Invest option chains, and we see it here. Here's the CBOE, and that symbol is CBOE, so it's very simple to remember. We are down about 1.5% today, based off of their earnings from last week, I think is mainly the driver of this. Last was 86.40. And here's when that earnings report was on the 31st is when that happened. It does pay a decent dividend, by the way. The underlying stock does 36-cent quarterly dividend. And if I scroll down, I want to look at it more of a short-term option contract. We do have some decent implied volatility in this. And here's all of the different expirations that we have available. We're going to actually look at the August 21st expiration. It's 18 days away. And we're going to go down just a little bit lower. Right now we're at 86.40. We're seeing a decent amount of implied volatility, 30% implied. Usually this stock will trade at I should say prior to the pandemic days, quote unquote, prior to the March lows, this stock used to trade around a 20% implied volatility. Right now, if I highlight this is the put chain. This is where the stock is at. We see that the at the money implied volatility is right around 31%. So you're getting a decent amount of premium here. So we're going to sell the 85 strike put with 18 days remaining for the August 21st expiration. And that's going to be our paper trade for this week, implying that if the stock goes down to 85 or lower, we're willing to buy that underlying stock. And for saying that we're willing to buy it, the bid right now is 160. I would try to work that a little bit because we're 160 by 195. So we got a fairly wide bid-ask spread, a lot wider than we do in the underlying stock. But overall, we're saying that if it comes down to that level, I would be willing to buy it at 85. Okay, if I'm saying I'm willing to buy it at 85, guess what? I have to have the money to buy 100 shares at $85. That's $8,500. And when you're trading options, you always got to remember to add commissions in. So let's go down and look at it in the strategy workbench here on the Ally Invest option chains. We see the midpoint is 180. So we'll make this officially the paper trade for this week. And I'm going to try to work it a little bit. I'm going to go, we'll call it 175, a little bit lower than the midpoint here. So if we sell this put option, that means if we could execute it somewhere close to the midpoint. A midpoint fill is never guaranteed, but if we could, that means we'd bring in $175 less commission for every one put option that we sold. And for every put option that we sell, we'd be saying if it's cash secured, we would be willing to buy 100 shares at an 85 strike price, or put up $8,500 to buy that underlying stock. Now, I want to highlight at a lot of brokerage firms, you can actually do trades like this inside retirement accounts. You can do it inside of Ally's retirement accounts. You'd have to check with your broker to see if they allow it. But if you have the cash to be able to buy the stock at a lower price than where it's currently trading, well, then you can do this type of strategy in some types of retirement accounts overall. So just keep that in mind. I always like to kind of highlight that when we're talking about cash secured put selling. So it's just a way to say, well, if the stock comes down, we see some value in the Chicago Board Option Exchange. We got some high volumes since the March lows. It actually set the all option trading, which is actually covered by the Options Clearing Corporation, have seen record volumes in options, and that kind of makes sense. It's a way to kind of protect your assets. The options can be used in that way, and because of that, we've seen a lot of high volume days on all of the exchanges across the industry. All right, so let me go in. This will be the official paper trade. And I'm going to just highlight our profit and loss calculator right here. And it'll look a lot like the actual and profit and loss graph in the options playbook. But here's where the underlying stock is at. It's fairly close towards that 86 level. If it comes down to 85 on down, we take on an obligation to buy stock on the way down. Once we would buy stock, then we would have substantial upside, all the upside of owning the stock, but still all the downside of owning the stock. So we're just saying that we'd like to buy the stock if it goes lower. If it does not, well, all right, then I'm going to take my $1.75 or $175 and I'm just not playing anymore, right? I don't have that opportunity to buy that underlying stock. It's going to be an 18-day trade, and it's going to expire on August 21st. All right, Lindsey. So with all that said, let's get to the questions. I see we have quite a few of them out there. Which one would you like to start with first?
Yeah, we've got a lot of questions out there. I'll start at the top with Scott Breyer. If you use a protective put or a collar to position as earnings are coming up, do you typically close out the trade after earnings pass? And would you use the weekly option or the monthly? I think we had talked about that last week.
All right. Yeah. So Scott is addressing something that's a little bit off topic because we're looking at Chicago at cash secured put selling. But in this day and age, especially with all the earnings that we've had this corner last week, and we got some more earnings coming out this week, a play to try to protect yourself is either a protective put, which this is, I'm showing it inside the options playbook, or a collar, which is right below the protective put. And these two strategies can be used to protect yourself against a short-term move to the downside around a stock that you might own. So the question really is, if I put a collar on, or if I do a protective put and earnings come out and the stock goes up, what would I do? Or even if it goes down, what's your plan? And a lot of times people would just close out that trade because you're doing the protection for one specific event, and that event happens. So after that event happens, you hope that it gave you some protection, allowed you to stay in that underlying stock going into that nerve-wracking earnings report. And so a lot of people will close that position out, even if the market goes down. So if I put on a protective put, what I'm saying is that I own stock, which gives me this substantial upside potential because I own the stock, but I'll have a limited and known downside. So if the market goes down, one thing that you can do is just sell the put and remain long the stock because that's what you really wanted to do in the first place. And a lot of people will look at these strategies and say, oh, I'm putting on a protective put, I'm putting on a collar, and I must be bearish on the marketplace. Overall, that's not true. Usually, if you look at the profit and loss graphs of both of these strategies, the protective put and the collar, I clicked on the wrong one, here we go, you see that you have upside potential on both of these strategies. So your best situation is you put this position on and the market continues on up after the big event. And in this case, Scott was talking about earnings. All right. Got a lot more. I got to keep my answers a little shorter to be able to get through as many as we can. What's the next one, Lindsey?
There's a lot of chit chat going on. It's interesting to watch. We've got some old Trade King guys. We've got some newer people to the Ally platform. Some have used Thinkorswim and other platforms. So they're doing a little chatting in the chat box, which is great. We love it. But some of the other questions that came in, Charles Ellington says, I'm a newbie trading, so forgive me for asking, but how is a stock? I guess I can answer that one, and you can jump in, Brian, too. An exchange can be a stock, if it's publicly traded on an exchange. So these guys make money. They're an exchange to they're a for-profit business. They're not non-for-profit. So because of that, they're able to be a public company and trade their stock. Again, like Brian went through the trade. The ticker is CBOE. Check it out. I don't know if Brian, you have anything to
well, I can see where the question comes from because basically back in the day, a lot of the exchanges weren't public. They just were considered nonprofit exchanges that were filling trades. But since that time, a lot of the companies have gone public. The NASDAQ is also a stock that you can trade that's an exchange. And overall, once they go public, then you can trade them. You can participate. You can buy the equity and have equity in that exchange.
Yeah, it definitely is something that seems weird and not intuitive. So I get where the question comes from. Absolutely.
Right. Good way to put it, Lindsey.
Let's see. Rag Piano. Statistically, aren't the numbers better on earnings than what the market has expected? And I'll just take that one. Yeah, usually every earnings season, about the historical average, 2/3 of companies beat their bottom line estimates versus what the consensus or Wall Street experts think. And we're above that this quarter. 74% of companies are beating, but that's because probably the consensus Wall Street analysts didn't have any guidance from companies, so they're kind of flying blind. But yeah, you're absolutely right. What else do we got for here? Let's see.
All right.
I think that's pretty much all the big questions.
Yeah, right. There's a lot of chatting that's just going on in the box, but overall, do you have any questions that are relative to the call today?
Well, one question, Scott Breyer had a second question for you. Do you compare IV, implied volatility, versus HV, historic volatility, to determine if an option is overpriced?
All right, so that is a loaded question, and I'm going to suggest I'm going to highlight inside the options playbook again, the book that I've written about options, going to what is volatility. It's in the option basics section. I'm going to click on it right now. That's a very short and succinct read about volatility. So the question is, do you compare historical volatility to implied volatility to see if an option is overpriced? And in general, unless you're a market maker, it's hard to say that an option is quote unquote overpriced. And the main reason why is that as you go into earnings, which is the main reason why we're talking about the CBOE today and everything that happened in the marketplace last week, implied volatilities will usually be elevated going into earnings more so than historical, because options are actually priced more like insurance contracts. And when there's an unknown event, they will become inflated. Does that necessarily mean that they're overpriced? That's hard to say. A lot of people will come in and say, well, market makers are raising the implied volatility going into earnings. And it's not really the market makers that are raising it. It's more so the money flows. The market makers are just reacting to order flows. And so I hesitate to say that when I look at historical volatilities lower than implied, that means that the option's overpriced, or the opposite, and options would be underpriced. The options are priced where they're at based off of the money flows in general. Now, how would I use implied volatility? If I were a buyer of option contracts, would I like the implied volatility, the 30-day implied, if you will, to be lower than the 30-day historical? Yeah, I would prefer that, but that doesn't necessarily mean that there is a value. It's based off of what's going on in the marketplace, and you need to think about adjusting your strategy based off of the fact that just the option contracts are trading at a high implied versus a low implied, but it doesn't necessarily scare me away from actually doing that trade because, quote unquote, the options are too expensive or not, or undervalued overall.
All right, perfect. I think that'll do it, Brian. But before we go, everybody, Brian is going to review this on Friday at noon, as he does every Friday. He reviews our trade of the week, our stock play of the day. And determines if any adjustments need to be made at that time based on what the stock has done over the course of the week. And I highly recommend you tune into it. Again, it's on Friday at noon, live stream. It's called Stock and Play of the Day Overtime.
All right. Thanks for coming, everyone.